Yeah, I think we have audio back. So we're looking at the monthly budget slide. I'm going to step back. And so we're going to talk about that $7,750 needed over a 10-month period. That's approximately $775 a month. That's a considerable fee, a considerable amount of money, rather. So what can you do? You can consider how you may get other income before borrowing. It's something where, if it's possible, if it can work for the student to get a part-time job, that's always helpful to bring in a little cash. If you can ask, if you have assistance from family members and friends, if you've got wonderfully wealthy relatives that you can ask. I know I've helped out a little bit with my nieces and nephews who are going to college. That's great. Any type of assistance that you may be able to get to help reduce that dollar amount that's needed. The third bullet is the most important one. Consider a school payment plan. So what's a payment plan? It's usually called a monthly payment plan, and each college and university that I've worked with over the last 10 years that I've been in higher ed, they'll have a payment plan. So what is it? It's a device that the school uses to allow you to pay over a period of time. Rather than paying all the money up front, you can spread your payments out over the academic year. Usually it's about 10 payments, one a month for a 10-month period. And rather than paying a large dollar amount once, you get to break it down into smaller payments. There's usually a registration fee or enrollment fee. It can be between $25 or $75 to enroll with a company. Some schools manage their payment plans themselves. Some schools utilize an outside vendor for their payment plans, and they're interest-free. So it's a great way to look at how you can not pay money up front, but where you can pay over a period of time and spread your payments out. So always look for the payment plan option. And you can combine. If you do end up having an amount that you can't make every month budgeting on a payment plan, you may have to borrow, but you'll be borrowing less, and that's an important point. The third is appealing your award letter. Now this is different than when I talked about federal work study, when you go back to the financial aid office and say, I'm really pleased that I've received this much information and this much aid on my award letter, but is there any opportunity for additional aid, perhaps federal work study? Depending on a financial aid office at a school, there may be some way that they can look and find additional dollar amounts. So that's a way a family can go back in and talk to a financial aid office representative one-on-one. And you should do that when you receive your financial aid award letter. If you don't think that there's enough listed there to cover what you think your family should have in financial aid, go back and see if the financial aid office can adjust it a little bit. Now, some financial aid offices will say they can't do that, some can. Okay, that's one way of kind of looking at your award letter. And is there some flexibility at the school? The second thing is appealing your award letter, and this is an official process. So in addition to going back and talking to someone in the financial aid office about your award letter, you may have an opportunity to officially appeal your award letter. You will have an opportunity to do that if there's been a significant change in the income or an employment status of either a student or a parent in the family. If there are excessive medical bills, if a student's parents have divorced, if unfortunately there may be disability or death in the family, or a significant increase in high consumer debt. If there are events like that that have occurred in the student or the family's life, then you can go back to the school and request an appeal of the award letter. Each school will have its own process or procedure. You will probably have to sit down and talk to someone. You'll have to submit a letter explaining the change in your financial circumstances. At the very least, you'll have a telephone interview. And then there's a good possibility that the school will be able to appeal the award letter and award an additional dollar amount. So you have your award letter at this point. You have looked at what's listed on your award letter in terms of federal aid, scholarships and grants, federal work study. You've looked at the direct loan program. You've decided you're going to take some dollar amount from the federal direct loan program. You've gone back and forth with the school. Maybe they've been able to adjust your award with a couple of extra $100 in work study. And you know that your student's going to take the $5,500 that are available in direct loans and yet there is still a remaining amount that you know you're going to have to come up with in order to cover the cost of education at your university. So how are you going to do that? You may look at other avenues. You may have a savings account where you can use some dollars from that savings account to cover the remaining need. You may look at an IRA or a retirement account. You may look at a 401 plan that a father, mother, even the student, if they've been working for a period of time, may have some money in a 401k plan. You may have home equity loans. If it's an opportunity, if it's something that's going to work for you, you may be able to put a small amount on a credit card temporarily. And you may look at private loan options. Now, each of these are going to be dependent on a specific family situation. One may work for one family, one may work for another family. I think out of all of these, credit cards would probably be the last choice that I would recommend for a family, but there may be times where you need to make a decision and you need to put a dollar amount on a credit card. If that works for you as a family, then that's the right choice for your family. So the remaining need can be covered by savings the family may have, a retirement account, a 401k, home equity loans, credit cards, or private loan options. One option that is available and may in fact be listed on your award letter is the Federal Direct Plus loan. Actually, more and more in the award letters that I see, both in print and electronic. I was just looking at one last week with a student, and it confused the family because the Plus loan was listed on the award letter for a dollar amount of over $28,000. And the family was asking me, does that mean I'm being awarded $28,000? Not exactly. What the school has done in that student's case was to list that the Federal Direct Plus loan is an option for that student and family. What the Federal Direct Plus loan is a loan that is available through the federal government, but it is in the parent's name. The federal direct loans we talked about earlier, the federal Perkins loans we talked about earlier, those are all in the student's name. But the Federal Direct Plus loan is in the parent's name. This loan is a little bit different. It can bridge the gap between what education costs are and financial aid. That means that a family that decides to choose the Federal Direct Plus loan can have it for a dollar amount that meets the cost of education less any financial aid the student has received. So if on an award letter you choose a certain amount for the student to take in direct loans and there's a $10,000 or $15,000 amount remaining, if the family decides that it's the best option, they can put all of that onto a Federal Direct Plus loan. Now this is a credit-based loan. It's made to the biological, adoptive, or in some cases step-parent of a dependent student. It is a 7.9 interest rate. There is a 4% origination fee. That means that the dollar amount that you take on the loan is going to have to include the fact that an origination fee is going to be taken off the loan when it's first dispersed. As I said, the limit is the cost of attendance of COA less any financial aid. An important distinction, unlike the Federal Perkins loan and the Federal Direct loans, where the student can choose to either pay interest while they're in school or defer that interest, and there is a grace period once the student is separated from the school, that is not the case with the Plus loan. Payments begin 60 days after the first date of disbursement. Now, usually with a Plus loan, there are 2 disbursement dates, one in the fall, one in the spring. That means that you are going to be required to begin paying back this loan 60 days after the first disbursement date. You may request deferment, and deferment is putting a pause on the loan where you don't have to begin making payments for a period of time, usually while the student is still in school. That's important to note. You have to request deferment when you are applying for the Federal Direct Plus loan. You have to state up front that you want to defer paying back on the loan while the student is in school. You are able to do that, but you have to do it up front. Like all student loans, there is no prepayment penalty. If you choose to pay back the entire amount that's owed on the loan early, you are able to do that. And one other distinction, if you are a dependent student whose parent is denied the Plus loan, again, there's a credit pull. So if the parent is denied the PLUS loan, the student may actually qualify for additional federal direct loan limits above the $5,500. Private loan options. There are a lot of different private loans out there, and before you choose to take a private loan, you really need to educate yourself on what a private loan is. Private loans are not loans by the federal government. They are by private banks, credit unions. They are very, very different than loans that are going to be by the federal government. A couple of things you should be looking at when you're looking at private loans. Definitely compare one loan or another. The schools that you work with are required to give you options in private loans. They can either say, go out and look them all up yourself, or as a school, we really like working with these top 5 lenders. And they're private loan lenders. Here's some information on them, or here's where you can find the information online, and you make the decision that is best for your family on which private loan to choose. When you are looking at private loans, you're going to see some information you may not be familiar with. The first is that the private loan is going to have an index. That means that the interest rate that is set on how much you're going to have to repay that loan is going to either be LIBOR or prime. LIBOR is set at 0.20%. Prime is 3.25%. Those are two indices that are used for private loan lenders use to set up what the interest rate is that you're going to be paying back. You take that index and you add onto it a margin. That is a percentage that is added onto the index that will increase the percentage amount, so it will show you exactly what interest rate you're going to be paying back. A lot of times you'll see something listed as prime plus 4%. That means prime 0.2 plus the 4% index means you'll be paying back 4.20%. Or if it's LIBOR plus 4%, that would be 4% margin added to 3.25% of LIBOR, meaning you'd be paying back 7.25 if it's a LIBOR-based loan with a 4% margin. Now those are just that's just one example. A lot of times you'll be looking at prime with a higher margin or prime with a lower margin. It's all going to be dependent on the type of loan you're looking at. The term floor may also be used. That means a percentage interest rate will never go below that amount, and that amount is considered the floor. For fees, you may have origination fees. Maybe there isn't one, which means 0, or they can go up to about 3%. Your repayment terms, basically, how long am I going to have to repay on this loan? They can go between 10 and 25 years. Borrower benefits. Again, they will be unique depending on the loan. WIFM means what's in it for me. When you are looking at different private loan options, consider what those borrower benefits are, and look really carefully and see, how do I qualify for those borrower benefits? Is it a borrower benefit that I know realistically my student and my family we're probably never going to be able to receive those benefits? And more importantly, what do I have to do to keep getting those benefits? And what would I do to lose those benefits? So each lender's loan product is different. So take a really hard look at what those borrower benefits are. What's in it for me? It's important because it can really mean a significant dollar amount less that you'll be paying back if you qualify for certain borrower benefits. It's also very likely, because this private loan is also going to be in the student's name, that the student may not qualify on his or her own for the loan. They're likely to have a co-borrower on the loan. That means another person who is going to be indebted as well as the student, and they are going to be responsible for the loan with the student. Ways that lenders look at, is this borrower really going to be eligible? They'll pull a FICO score, or they may look at a debt-to-income ratio for the borrower first, the student. But again, it's very likely that the student's not going to qualify for the loan on their own. They won't have had enough credit history, they won't have a work history, they won't have enough income per month. So the lender is going to then request a co-borrower. and that can be a parent. It doesn't have to be a parent, but it usually is. That's someone whose name will also be on the loan. And that person, again, is going to be responsible for loans. So it's a significant responsibility to be a co-borrower on a student loan. Because if for whatever reason the student's not making those payments, it's the responsibility of the co-borrower to make them. Once you separate from school and you begin repaying on the loan, there are different options. You can use a full deferment payment. You can use principal and interest payments, which means just what it says, you're paying on the principal and the interest that's been building up. Or some lenders use what are called good faith payments, which are smaller payments than you're expected to pay for your larger amount. But each way that you repay the loan is going to be different based on the loan. And for any undergraduate loan, either a loan that you're getting in the student's name from the federal government, the federal direct loans, the loans that a parent may have, like a PLUS loan, or the student private loan options, working with the lender, if it's the federal government for the government loans or private lenders for private loans, will be very important when you begin the repayment process. Your lender wants you to be a good borrower, either the federal government or a private lender. No one wants you to default on the loan. Everyone wants you to be able to make payments on the loan. So it's important that you borrow the right amount that your family can afford, and then you're sure to be working with your lender, again, either the U.S. government or your private lenders, to ensure that you're going to be able to repay that loan in the best way possible. Both the federal government and private lenders will have different options for you to choose to make sure that you're able to pay that loan back effectively. So again, I know I ended with loans, but I really don't want the focus of this presentation to have been loans. What I've really wanted is to give you enough education so that you will borrow the least amount possible. You want to look at your award letter, see where the school is offering you money that you do not have to pay back, take advantage of lower cost federal loans if you do have to take them. Those have the best options available, and they have the best repayment options and the most flexible repayment options. So take a look at your federal student loan options first, and then consider if there is a gap, an additional amount you have to pay back. Can I use a savings account? Can I use a vehicle that's going to work for my family? Is a PLUS loan the right option? And then at the last instance, is it possible maybe I need a private loan? And if you do, take a good hard look at the private loan options that are available. Now, if you have questions about anything that I've talked about tonight, if you're even in a process where you haven't yet completed your FAFSA and you haven't received an award letter yet, you just have come on the call because you wanted information about an award letter, if you have any questions at all about the financial aid process, we have a free service called Scholar Help at studentchoice.org. Student Choice is an organization that works with credit unions across the country. So we are not for profit, and our credit unions are all not for profit, and so there's no charge or fee. If you have any questions, you can write to scholarhelp at studentchoice.org, and my colleagues and I will be happy to provide you an answer, and we'll be back to you within 72 hours. That's our promise. So that's the end of the presentation. I hope we've been able to give you information that's going to be useful for you in the financial aid process. I want to thank again College Week Live for giving me an opportunity to talk with you tonight. Again, if you have any questions at all, please send them to scholarhelp at studentchoice.org. Thanks very much. Oh, and sorry for the technical difficulties. Good night.